Hi everyone, my name is Yan. I'm an investment analyst at TDK Ventures, focusing on climate tech investment. Welcome to the second spotlight interview for the day. I know it's hard to follow the interview with Jiga Shah, but fortunately, I think our guest from this session is just the right person to fill that role. He's one of my favorite voices in the climate space because every week I will look forward to another episode of his podcast series, Catalyst. But being a popular podcast host is probably one of his most modest achievements, given that he's also an investor advisor to NYSERDA and Prime Impact Fund, a non-resident fellow at the Columbia Center on Global Energy Policy, founder of GTM Research, and above all, a partner at Energy Impact Partner, also known as EIP, which is a collaborative strategic investment firm that invests in companies optimizing energy consumption and improving sustainable future. Please welcome Shayle Kann. Hi Shayle, how are you?
Good morning. I'm good. How are you?
Good, that's great to hear. So Shayle, I know you've done a number of podcast episodes on Inflation Reduction Act, and every single one of them was extremely insightful. So today I'd like to pick your brain further on this topic and explore with you the implication of this bill on climate tech innovations. This session will be an hour long. The last 15 minutes will be reserved for Q&A. So everyone in the audience, please don't hesitate to put your question in the Q&A section or upvote other people's question. We'll go through the top voted one toward the end. So I think most people in this room are fairly familiar with IRA by this stage, but just a quick recap. It is a budget reconciliation bill that was passed in August, focusing on healthcare, tax reform, and climate change. It includes a $370 billion investment towards climate change and energy security, representing the single largest climate investment in US history. So, Shayle, I remember from one of your episodes in early August, you mentioned that you actually skimmed through the bill the night when it was released. What was your overall take after that first pass, and has that changed since then?
Good question. First of all, since we're going to be talking about this bill for the next hour, I feel like there's still open debate about whether we refer to it as the IRA or the IRA. And I've heard strong voices on both sides of this. The IRA has connotations in Europe that you don't necessarily want. IRA is the name of my uncle, so I don't know which one is better, but I'm going to call it the IRA just to
Okay.
keep it simple. I did try to read it the night that the bill text was released, but it's 700 some pages, so I'm not that much of a speed reader. But what I will say is it's pretty clear when you go through it almost immediately how big it is and how wide reaching within the climate tech context. It affects so many different sectors. And in each of those sectors, the bill has what amounts to likely a transformative policy regime, usually tax credits, but there's some other stuff in there too. So for every one of these, I was looking at this and I'm reading the hydrogen section and I'm like, oh my God, this is going to completely change the hydrogen market. Same thing for batteries and EVs and upstream methane and renewables and batteries on the grid, all this stuff. It's every single one of those sectors. Direct air capture, they all get totally transformed by this bill. It's interesting, the people who are deeply embedded within climate tech world, I think have started to appreciate how big this bill is and could be. You mentioned that the Congressional Budget Office estimates are that this is like a $380 billion investment. I'm fairly confident that number is low. It's not a specific allocation. There's tax credits with no ceiling, so they're just estimating how much it's going to be worth. There have been a bunch of folks since then who've estimated it's going to be twice that, which would not surprise me at all. So I think people in climate tech world have started to appreciate how big a deal this is going to be. I don't think the broader world has appreciated it. It's like the biggest climate bill ever passed in the US by orders of magnitude. And I'm not sure that the general public knows that yet, partially because it's just wonky tax credit stuff. But anyways, to answer your question, my reaction upon skimming the bill was I had trouble sleeping that night, thinking through all the ramifications and trying to figure out what it was going to mean.
Yeah, definitely agree with the magnitude of capital being brought to the climate tech space. I think Jesse Jenkins, in his repeat project, he mentioned that this could inspire not just billions, but trillions of dollars to flow into the sector. Do you feel the far-reachingness of the bill also demonstrate itself through the stakeholders' commercial readiness? Or maybe a better way to ask is, do you feel the bill is pretty fair in its distribution of benefits across companies of different commercial stages, startup versus corporations, especially pre-revenue startups that are maybe still doing R&D work?
That's a good question. So the way to think about this bill is that everything within it lasts 10 years, lasts to 2032, right? And after 2032, first of all, anything could happen during that time, but it's very rare historically that we peel back existing tax credits in the US. It does not happen very often. Once we've given something away, it's really hard to pull it back, especially if there's a strong constituency in favor of it. So I think the betting wisdom is that most of these tax credits likely last the period that they are contemplated in the bill. But after that, we have no idea. So to your question, I think what it does do is puts the onus on deployment. Most of this money in the bill, with some exceptions, and the loan programs office gets like a huge inflection of capital to invest in sort of more first of a kind, but still large scale first of a kind stuff. But most of the money in the bill is going to go toward deployment and deployment at scale. So I do think that it advantages those who can move quickly over those who are going to take 7 years to come to market. Good example would be next generation nuclear is one category that in theory benefits a lot from this bill. Nuclear gets included in this technology neutral production tax credit that got introduced. But if the tax credits run out in 2032, a lot of this next generation nuclear is not even scheduled in an ideal world to come online until the last couple of years of this decade. So then you only get a few years of deployment before the tax credits expire. I think in general, 10 years is a long time. And so if you have a technology that you think can hit market adoption and scale well within this decade, then this bill is potentially got something really big for you, but it disadvantages anything that's further out than that.
Yeah, that's true. And I guess there outside RA, there's Chip and Science Act, which has more R&D dollars, which I think startup could take advantage of.
Yeah, not to say at all that there aren't other resources that really early stage technologies
Yeah,
can take advantage of. There's all sorts of other funding that's available, but specifically the big bulk of the cash from this bill is just all
yeah,
about either manufacturing or deployment.
yeah. And even though I think early stage startup cannot directly benefit from those tax credits, do you feel like there's more willingness from the investor side to start to pour money into some of those early stage technologies?
Yeah, I think it's still early days there. I'm sure we will talk about. There's a lot of uncertainty still in certain provisions in this bill and how they're going to be implemented. And so I think investors also are generally still wrapping their heads around what it means for their theses in the market and who to invest in. In general, the way to think about this bill at the highest level is that it made everything clean cheaper. And so if any early stage company in any of the sectors that the bill touches that has a solution that has long term legs to decarbonize one of these major sectors of the economy that benefits from the bill, I think you can safely assume that when you bring it to market, as long as it's within the next decade, it's going to be advantaged relative to the emitting alternative. The question is, will it be advantaged relative to the other clean alternatives? And that's where it's a company specific and technology specific question. So I think investors in general, those of us who were already investing in all these categories and all these technologies, it doesn't fundamentally change what we want to do. I think it provides an accelerant and a catalyst for a lot of new technologies, but it didn't suddenly make a whole category interesting that wasn't interesting before. It just makes everything look better.
That makes sense. And maybe a follow-up question on that. I'm curious to hear, so EIP Frontier Fund is a deep tech climate fund. What is the typical timeline and maybe type of risk that your guys are comfortable with?
Yeah, good question. So in general, we have a flagship fund that invests later stage when technology risk has totally been retired and helps companies scale up and through their growth journey and so on. Like you said, where I focus is what we call our frontier fund, which is our early stage climate tech, deep tech fund. So for us, we like to invest before the technology is fully proven at commercial scale. We're willing to take some technology and engineering and scale up risk. And we like to invest early as long as it's a really big swing and a big problem in climate. With that said, we don't invest in an idea. We'd like to see some proof of concept of the technology. So typically, if you're thinking about this on like a technology readiness level scale, which is a common way to compare across technologies, we start at TRL3, which usually means that there's like some kind of proof of concept, but it can be a benchtop scale reactor, for example. So it's not an idea on a napkin, but it's not in the market yet. So we'll start at TRL3 and then go all the way up through TRL8, which basically means there is a proof of concept in the field, maybe at smaller than ultimate commercial scale, and remaining tech risk is just scale up. So that's our range. And again, I would say in the context of the IRA in particular, if you're doing something where the economics of your system are ultimately going to be reliant on or heavily benefited by the tax credits in the IRA or something that's in the IRA, then what we want to see is a path to market where you expect to be deployed at full commercial scale by figured 2026 or so. Now, there are things that will take longer than that. And if it's a big enough deal, if you're totally reinventing steel making, it probably will be worth it anyway. But in many cases, we want to see the ability to get to market in, say, 3-4 years at the outside. But again, it sort of depends. And we structured this as a 15-year fund specifically so that we can invest in things that have a longer time horizon if we see the opportunity as being large enough. We've invested in a nuclear fusion company, for example. I have no illusions that we're going to have commercial nuclear fusion reactors operating this decade. But again, the size of the prize makes that worth it anyway.
Yeah, that makes a lot of sense. And do you have any suggestion to startups on like how to scale up quickly or how to de-risk their business and get to the market faster? Yesterday we had a chat with Rick Nittman, who used to work at TPG. He raised a really good point. Instead of scaling up, you try to scale out so you can have multiple of the same module. That usually allow people to get to the market a little faster. Wondering if you have some thoughts on this methodology or any tips you like to share.
Yeah. So I think in these deep tech companies, the pace of scale up is one of the fundamental challenges because you're balancing on one hand, you don't want to get out over your skis and spend tens of millions of dollars and thousands of hours designing a system that isn't going to work or isn't going to have the specs that you need. And so there is a real reason why there's been historically a very clear path to scale up. But on the other hand, that historical path to scale up often it takes too long, or at least longer than you want. And depending on what you're trying to do, sometimes can leave you behind. I think that traditional thinking is one order of magnitude of scale up each time, right? And so a lot of companies, we say, okay, we're going to do, let's just pick the unit that you're going to do. We're going to do a 1 gram thing and then a 1 kilogram thing. And then we're going to go up from there stage by stage. Sometimes that is the right thing to do. But I think it is always worth actually probing the question of, is that necessary? What is the fundamental risk that needs to be retired at each stage? And could we skip one of those stages and still retire that same fundamental risk? What are the trade-offs when it comes to capital intensity? How much are we going to have to spend to do it? Those are all relevant as well. But we've seen both things happen. Sometimes a company gets out ahead of themselves a little bit and then has to retrench, and that's painful. On the other hand, we have seen companies take a couple of years longer than I think they could have to bring their product to the market because they were really focused on this methodical scale up approach. So I think sometimes it's good to have fresh thinking who has a strong technical background in another sector come in and say, what could we build here and how fast could we move? This is where the DNA of companies like Tesla and SpaceX are really nice because the culture at those organizations, and there are others as well, starts from the thesis of what if we could do it, and then builds back into how would we do it. And oftentimes, particularly technical founders who are early stage, come at it from the other perspective, like how do we do it, not what if we could do it even faster. So it's always going to be situation specific, but one common thread that we do see is there's creative thinking that you can do within the bounds of physics where you can sometimes accelerate early stage technologies.
And like you said, the RRA, the credits are only there for 10 years. The policy could change, it could get cut shorter, so get to the market faster. Okay, so far we've been discussing kind of the broader implication of the bill on climate tech innovation. Next, I want to dive into two technology that have a pretty significant presence in the bill and also two core topics of our Energy Week, hydrogen and batteries. Let's start with hydrogen. So hydrogen is long known as a sustainable fuel, but as our panel from the hydrogen panel point out, 95% of the hydrogen produced still based on fossil fuels. Do you think the amount of tax credits being provided by RA could substantially change that in the near term?
So hydrogen is one of the ones where what is yet to be decided may be the most important set of things. So what we know is that there's a few things in the bill for hydrogen. The main one that is the most important is this hydrogen production tax credit. And the headlines around that call it a $3 per kilogram tax credit. The reality is much more nuanced than that. There's a couple of important dynamics. The main one is this. There's a tax credit in the bill that, first of all, to get to any of these high numbers, you have to hit prevailing wage and apprenticeship guidelines that mean you have to use union labor in some cases, things like that. So let's just assume everybody does that. Then the level of the tax credit depends on the calculated life cycle emissions of the hydrogen. So to your point, the hydrogen that we are producing for the most part today would not qualify, basically at all, for any tax credit. But there are varying levels. $3 is the high water mark. That's for if you are beneath a certain threshold of life cycle emissions, you get $3. If you're above it, you can get like $1, and then there's another threshold above below that in terms of the tax credit. So we know what the threshold is. What we don't know yet is how exactly we are going to calculate hitting that threshold or calculate the life cycle emissions in general. There has to be guidance that comes from Treasury next year sometime. That is going to make a huge difference because imagine green hydrogen, electrolysis based hydrogens. You split water using electricity. You could have a spectrum of how stringent those rules are in terms of emissions accounting. If you wanted to make it as loose as possible and as easy to qualify as possible, you would basically just say an electrolyzer can use grid electricity. It doesn't matter what grid electricity they're using, where they are on the grid, what time they use that electricity, but they have to purchase renewable energy credits on an annualized basis to match their total load, and then they qualify all of that electricity as zero emissions, and then they'll get the $3. That's the easiest possible thing. That would make it extremely easy to get the $3 tax credit. On the other end of the spectrum, if you want to make it as stringent as possible, you say that electrolyzer needs to be purchasing local, additional, and time matched clean energy. And you have to calculate each of those things. The electricity that you're purchasing from has to be nearby without transmission congestion within that zone. It has to be new build resources, and it has to be matched on an hourly basis rather than just an annualized purchase. That significantly constricts the ability of a given project to qualify. And that's just for green hydrogen, right? So, for example, on your point with fossil fuel based hydrogen, there's two ways to decarbonize fossil fuel based hydrogen at the high level. You can do post combustion carbon capture, which people call blue hydrogen, or you could do methane pyrolysis, which is essentially pre combustion carbon capture, and people call that turquoise hydrogen. Either one of those depends on the amount of capture that you were doing, so how much is still released, but more importantly, from an emissions accounting perspective, how do you calculate and account for the upstream emissions embedded in that natural gas from upstream methane leakage? And depending on how that upstream methane leakage gets accounted for and calculated, it's possible that none of the fossil fuel based hydrogen could qualify for the $3, or it's possible that some of it could. So that's a long winded way of answering your question, but the short answer is that I just don't think we know for certain yet what will and won't qualify until we get this guidance from Treasury. We have some ideas. We know based on the sort of current model the calculation will be based on, it's really difficult to get beneath the threshold for the $3 credit currently with any version of natural gas-based hydrogen and any sort of normal grid mix of electricity. So if you just left it at that, then you would say it's actually fairly difficult to qualify. But there's lots of lobbying going on and decisions around how we're going to calculate all this stuff that we'll know in the next, I think, 6 to 9 months that we just don't know today.
Super interesting. Do you see people holding off the development, because of the uncertainty, or people just go ahead and maybe future-proof their projects?
Yeah, it's a really good question. There's two dynamics pushing against each other. On one hand, there's a race to get things built. I think the long pole in the tent remains hydrogen demand. Who's actually the purchaser of clean hydrogen? Even if it's cheap, even if you can make clean hydrogen a fossil parity, somebody's got to buy it and use it for something. And we don't have that much infrastructure for that yet. Obviously, there are existing facilities that currently use hydrogen, like ammonia plants and petrochemical facilities. But beyond that, a lot of the excitement is around using for hydrogen for things it's not currently used for. And so there's some process before you get to the point where there's a real buyer there. So there's a real rush to lock up buyers, I think. And in some cases, there's sort of real investment decisions moving forward, but not that many yet. I don't think we're reaching final investment decision on a lot of projects. I think there's a lot of earlier stage development going on in advance of that with the hopes that these projects are somewhat future proof, to your point. Maybe they would meet the more stringent guidelines. And once we have Treasury guidance, we're ready to pull the trigger immediately, because this is definitely a market where we're going to see a rapid scale up over the next 3-4 years. And I think if you just sit around and rest on your laurels, there's a decent chance you will get left behind if you're saying it will deploy in 2029 or something like that.
Yeah. And how are we doing in comparison to Europe, which I know has long been leading the hydrogen development? Do you feel like the RA could potentially, supercharge the US hydrogen economy so that it surpass Europe?
It's hard to say, actually. So I think Europe has had much more attention paid to hydrogen, more years of development, more companies that have made commitments around it, more actual projects that have been identified, and historically more subsidies that have been at least contemplated. But Europe faces a different version of this similar, like, what is the qualification criteria question? And I think is taking even longer to answer it than the US is likely to. And so there's a whole different set of questions there. I don't think the US is necessarily going to leapfrog Europe in hydrogen demand, though interestingly, maybe in hydrogen supply, which is an important distinction, right? Europe will produce a bunch of clean hydrogen, but fundamentally does not have as much land, does not have as much cheap power, does not have cheap natural gas. And so, depending on the type of hydrogen you're trying to make, that's how you get cheap, clean hydrogen. So I wouldn't be surprised if what ends up happening is Europe is a big demand sink for hydrogen, but imports half of it, not just from the US, but the US amongst other places.
Okay, so that will require thinking around like hydrogen storage and transportation. Do you see in the bill specific tax credits for those topics? I think you mentioned that there could be the scenario where hydrogen get exported from US to Europe, but that will require probably some creative thinking around how do we store it, how do we transport it. Do you see in the bill, are there any specific tax credits that go toward hydrogen storage and transportation?
No, there's nothing in the bill that specifically supports hydrogen storage or transportation, as far as I know. But what the bill does do, if you can qualify and you can figure out how to get projects built, which is its own set of challenges, but assuming you can, it just makes hydrogen cheap. And so then it relies upon the market to figure out what are we going to do with this hydrogen? And if we're going to export it, in what form are we going to export it? So there's nothing specific in the bill for a hydrogen carrier or ammonia or methanol or any of the ways that people are talking about, or hydrogen liquefaction or anything like that. But to me, that's a problem the market will solve. If you have cheap hydrogen, you have demand for that cheap hydrogen. We'll figure out how to ultimately get it from where it gets produced to where it needs to be.
Yes, makes sense. Okay, so let's switch to batteries. I know that the battery provisions are more complicated and nuanced, and you did a great episode with Sam Jeffy on this topic. And I would recommend anyone who wants to learn those provisions in detail to listen to that episode. In summary, there's component tax credit, there's critical mineral tax credit, and manufacturing tax credits, which all have their own specific requirements. Given the strict qualification requirements and building out factories take time and optimizing the factory also take time, how much do you think the bill will actually change the battery manufacturing and production landscape domestically and maybe globally as well?
I mean, I think we're already starting to see it, right? Like even since the bill has been passed, we've seen a bunch of announcements. There was already a movement toward re-onshoring of manufacturing capacity for batteries, and this is just going to supercharge that. There's components of the requirements to qualify for the EV tax credit that are a challenge, and critical minerals and stuff like that. We're already seeing what is likely to be a kind of bonanza of new battery manufacturing capacity in the US, both to particularly to serve the electric vehicle market, but also to serve stationary energy storage on the grid. So I think it's, again, an accelerant for a pre-existing trend. This was already starting to happen a little bit, and now it just makes the investment decision a whole lot easier for battery manufacturers.
And do you think that we have enough material supply to support the transition?
I'm not the expert on that. Sam is from that podcast. So I don't know for certain. There's a difference between, do we have enough? Is there technically enough resource? And the answer to that is almost always yes. There's technically enough resource in the places that we qualify. That the harder questions are, can we access that resource? How economic is it? And what's the timeline, right? Building a new mine takes a long time. And then building a new refining plant takes a long time. And again, these tax credits expire in 2032. So that's where smarter people than I, who are deeper in this space, can look at how many projects are further along in their development already, when they're going to come online, where we can have hiccups and periods over the next decade when we hit a short supply of various minerals or cells or batteries, whatever it might be, which then we solve by the end of the period. So I don't know. It does seem like it's complex enough and there's enough requirements in there that it's not going to be smooth, I don't think. But back to the original question, it seems clear to me that it is going to incentivize meaningful expansion of domestic manufacturing capacity.
Yeah, that makes sense. And add on to the mining aspect, the permitting process is long, and the mining itself has like a whole list of social economic or social environmental concern around it. I can see maybe recycling becoming a group of technology that help supply those materials.
Yeah. Permitting across a few of these sectors, certainly in the battery minerals space, but also in electricity, we extended the tax credits for renewables, which means we're going to build out so much renewables. Transmission becomes the real bottleneck there, and that is a permitting problem as much as anything else. Across the board, you make all this stuff really cheap, and then you start to expose where are the seams that will rip as we expand these markets. And I think in a lot of these cases, it's going to end up being permitting of something.
Is there anything you wish to see in RA?
I'm not enough of a legislative expert to know what could have gone in there, because there's specific things you can put in a bill like this and things you can't. So, for example, something that you maybe could not have put in this bill, but I would have liked to have seen, I'd like to see ARPA-E's budget doubled, for example, that type of thing to support earlier stage innovation. But that wasn't in the bill. Otherwise, I think it's pretty good. The other thing that's a little complicated about the bill, we haven't talked about this other category, which is the carbon capture stuff. So it increased this credit, 45Q, which is a tax credit for carbon capture, and it bifurcated it. So if you do point source carbon capture now and you sequester the CO2 rather than utilizing it, you get an $85 a ton tax credit, which is really rich for point source capture, at least from highly concentrated sources. If you do direct air capture, you get $180 a ton and you sequester it, which is a really big tax credit. So that's a big boon for the carbon capture market. But what's emerging in carbon removal is a much wider swath of ways to remove CO2 from the atmosphere. And the way that the 45Q is written, at least currently, it's pretty narrow. So it's specific to direct air capture, and you specifically have to be capturing carbon oxide. So there's a bunch of categories of carbon removal that don't qualify for these credits. And so you create a sort of unfortunate dynamic there where you create an uneven playing field for certain carbon capture technologies or certain carbon removal technologies in particular over others. So I would have liked to have seen a more pathway agnostic carbon credit, but those are probably the main ones I would have liked to have seen.
Very cool. Are you going to do a podcast episode on carbon capture, specifically around like IRA's impact on carbon capture?
Not immediately. Not planning any more IRA specific episodes of the pod, but I will say as this guidance starts to come out and we get a little bit more clarity on some of these areas that are still a little bit murky, I think it will affect the market. And so we'll naturally have to talk about it.
Yeah. One of the topic I'm personally interested in, methane emission, which is like probably the only stick in the bill. You see a lot of remote sensing technology out there can measure the methane leakage, but I wonder what kind of business model will actually work for those technology to take off. So maybe we can discuss that in a future episode as well.
Sounds good. Yeah, the methane fee is one of the categories that has gotten less attention from the bill, but is equally important to many of the others. And like you said, it's the only one that's really a stick as opposed to a carrot.
Awesome. Okay, I think we're a little ahead of time. That's all the question from me. So let's move on to the Q&A section. I'm going to go from the top voted one. How do you see technology of hydrogen generation from methanol?
Technology of hydrogen production generation from methanol. So that's like splitting methanol for hydrogen. I don't quite see why you would do that. You need hydrogen to produce methanol, and methanol is a hydrogen carrier. So I guess the way that I think about it is the ways you're going to generate hydrogen are more likely to be by splitting water or splitting natural gas or something like that. Methanol, you will produce using that hydrogen for existing purposes. There's an existing market for methanol as a chemical precursor and in petrochem. Methanol also may be a hydrogen carrier for transportation, and it may be a shipping fuel. So Maersk, for example, one of the biggest shippers in the world, they've been ordering a bunch of methanol-ready ships. And so methanol is in the running. It's one of the sort of, I think, two major potential hydrogen carrier fuels for shipping purposes. It's competing against ammonia, and we're trying to figure out which one is going to make more sense. So that's where I think there's a big role for methanol. Also, potentially methanol to jet fuel. There's lots of things you could do with methanol. But for me, splitting methanol back to get the hydrogen out of it probably doesn't make sense. Probably what you do is you make clean hydrogen, you produce methanol with it, and then you do something directly with that methanol.
That makes sense. So next question, how do you see the move that Chinese manufacturers will take? We see Catel is coming and building factory in Mexico and Goshen building factories in Michigan. How you see this will impact the local supply chain?
I'm obviously no expert on what Chinese manufacturers will do. I will say you're seeing the same thing happen in solar, for example. Chinese manufacturers of solar cells modules are announcing manufacturing facilities in the US. This probably gets into broader geopolitics, but there's a case to be made that was the point of the bill, right? We want domestic manufacturing. The origin of the company that does the domestic manufacturing may not matter. What the bill was intended to do is in-source manufacturing, create those jobs, all that kind of stuff. So unless something changes, and in some cases there may be like trade protections that make it such that Chinese companies can't qualify for whatever programs or credits, but then I think they're going to do what every other company is going to do, which is look at setting up manufacturing in locations that qualify, which often will mean the US.
Great. Okay, so next question. How do you think the ability to choose ITC and PTC will affect new deployment of clean energy, particularly as it relates to geographies where there's already growing curtailment versus where there's a considerable gap for production?
Yeah, it's a good question. I'm not the expert on this. It's a project specific. It's ultimately going to be an economic decision based on individual projects. It does provide a lot more flexibility, as you're saying. So, what happens in post 2025 is you get this technology neutral tax credit, which you can choose the investment tax credit, which is a fixed tax credit based on the total cost of the system, versus a production tax credit, which is based on total production, obviously. I don't know enough to know what the proportion of selection of one or the other is going to be. I think ultimately it seems like in most cases the production tax credit will be more lucrative, at least for solar. We've spoken to a few project finance attorneys who are running these calculations for future projects right now, and it really comes down to the specific characteristics of a given project. But again, the high level takeaway for me is you've got these tax credits till 2032. They're going to remain fairly rich. They're technology neutral, and you can select between the ITC and the PTC. It's going to make a lot of projects very economic.
Yeah. Sounds great. The next question, fees in China are a lot more democratized than in the US. Here, only a fraction of the upper middle class can afford a Tesla. Is the IRA funding enough to make EVs more democratized in the US?
Well, the tax credits are sort of intended to do that. They're income limited and they're vehicle price limited. So if the vehicle is like over, I think it's $80,000 or something like that, you can't get the tax credit. So certainly that's the intent. The tax credit is up to $7,500. And so you can decide whether a $7,500 tax credit is enough to push the price of EVs down from where they are today to sort of a price where they're available to everybody. I do think that certainly as you get further and further out into this latter part of this decade, that's a sizable tax credit. And as prices of EVs come down, as battery prices come down, and more manufacturers start making cheaper models, which is definitely happening, it feels to me like that, at a minimum, it is an accelerant of EVs for the middle class. I don't know if it's the single thing that will make all the difference, but I do think it will help in that regard because it is true that the income demographics of EV ownership today certainly skew higher end.
What do you think is stopping the OEMs to add tax credit onto their existing price, given that the qualification, they might see a higher production cost?
That is a good question. It's a weird market dynamic right now. Vehicle prices are very high in general right now because of supply chain constraints. And so it's a temporary phenomenon, but prices are already very high. I don't know. You have to assume sufficient competition that manufacturers won't be able to price gouge and just increase the price of EVs by $7,500 across the board. I do think that a lot of vehicle OEMs have been planning to release what they think are going to be the sort of widespread adoption middle class EVs just over the next few years. So they want those vehicles to be priced affordably for a big enough swath of the population that I don't think it's necessarily to their advantage to just raise prices equivalently. But I don't know. It's a good question.
That's where I started to see people say, oh, maybe carbon tax is the better strategy. So that cannot be pushed on to the customer.
That might be true. And who knows what the ideal way to subsidize this stuff is. But this is what we've got. And it's like much bigger than anything we've ever had before. So I'm personally not looking a gift horse in the mouth. I'm just trying to figure out how to take advantage of it and how to implement it.
Yeah, fair enough. Okay. So next question, is it realistic to assume that the dollars from IRA to meaningfully flow into the battery metal slash mineral sector, given the long lead times associated with developing mine and refining projects? What other sources of capital should step in?
I think that gets to what we were talking about a bit before, the dynamic of the value of the credits against the timeline of development of this stuff. I think it really advantages anybody who was already in development on a project. I think it's tougher to imagine going from complete greenfield today to full operation. The tax credits make a huge difference. Again, you can run your underwriting and figure out, like, let's just say we have 4 years worth of tax credits by the time we get this thing up and running. Maybe that's worth it anyway. Maybe you would still want to do it. But if not, then it makes it difficult. Some people also are making an assumption that these tax credits won't just disappear in 2032. And maybe they will change a little bit. Maybe they will decline. Maybe they'll just get extended. This is what has happened with solar and wind over and over again. We just keep extending the credits. So that's possible too. But again, I think it's particularly beneficial if you're already in development on a project. It's less attractive. It's certainly less if you're saying, like, I'm going to start from scratch and go prospect a new mine or a new refining facility tomorrow.
Yeah, makes a lot of sense. Another question, who verified the amount of carbon being captured and sequestered in order to qualify for IRA tax credit?
That is a good question, to which I don't know the answer, except I assume that this is going to be part of the Treasury guidance as well. This is not my area of expertise, but basically every one of these major provisions, we have to get guidance on implementation. The easier ones that are the existing tax credits that are getting extended or modified are coming first. So I think we'll get guidance on like the ITC and the PTC first, and then they're going to tackle the harder ones, which I think is hydrogen for sure. And I believe the 45Q carbon capture is new stuff, but I don't know. There's probably somebody else on the line here who has worked with 45Q already and knows what the measurement guidelines are for that one.
Yeah. So I guess we just have to wait for more clarification on that. Okay. So from Anil, the US government LPO or DOE do not cover mining of raw materials. Given massive shortage of raw materials in the EV sector, includes electrification of everything, who will fund this work?
The US government definitely does cover mining of raw materials. I mean, there's lots of programs that do, like the RBE has funded a bunch of work there. LPO can fund refining projects at least. I mean, we should have asked Jigger this on the last conversation rather than me because this is his area of expertise. I don't know if they can do pure mining, but they can definitely at least do refining. I think the government will get involved, but setting that aside, like not every project needs to be funded by the government anyway, right? If these are economic projects, they should get funded by the private sector, I think. And many of them are, right? There's lots of announcements of new domestic mining or refining projects that you've seen of late, which are not reliant entirely on the loan or loan guarantee.
Mm. Yeah, we had Chelsea on last night, who's also from LPO, and she mentioned that they do everything downstream of the mining. So, like you said, processing of the minerals, but not direct mining.
That's probably right. Yeah, that makes sense.
And is EIP looking into funding mining related projects?
Definitely. I don't think we would necessarily be the ones to finance a mine, but there's a ton of technology being developed around everything from exploration to mining efficiency and automation to refining. I think a few categories that we are super interested in, and if there's anybody who's working on something exciting, we'd love to know about it. Obviously, battery minerals in general, and there's lots of stuff going on in like direct lithium extraction and all those categories. We're interested in nickel and different ways to get sufficient nickel of battery grade quality. The one that I think gets less attention, but I'm personally super passionate about, is copper, which is less relevant specifically for batteries. But I think we're facing a pretty serious looming copper problem because it's a much bigger market today, much more mature, but demand is increasing. And those are trends that are going in the wrong direction. We still only recycle a pretty small portion of end of life copper. There's a lot of copper resource out there. We have no shortage of copper resource, but it's lower quality. So if there's a better way to refine it, that's economic, that's attractive. Anyway, to answer your question in brief, very interested in anything in battery metals, mining and refining, and outside of batteries, the broader energy transition, metals, minerals like copper and rare earths and things like that.
Perfect. So those are the two topics that TDK Ventures are currently looking at right now as well. A lot of people talk about battery metals like better materials, but copper is used way beyond just battery, and it's used in the transmission lines, conductor. It's used in the construction sector, so the demand for it will always be there and will continue to grow. So how can we recycle those more effectively? Because creating a new copper mine is probably not really realistic in the near term. So how can you collect more and recycle more? That's probably the solution. Another question, it looks like South Korean manufacturers are leading the pack in battery production in the US. Do you see a Northvolt then takes first in the US?
That's a really good question. I've seen a couple proposals, I'm sure you have too, for companies that want to replicate Northvolt in the US, but I haven't seen any major investment decisions made about it. Now would be the time for sure if somebody's going to do it. So I'm interested to see whether it happens, but we haven't seen it yet, which I find interesting because Northvolt has obviously gotten pretty big in Europe. I think Probably somebody's going to take a shot at it. If you made me guess, we've seen a lot of specific domestic LFP cathode manufacturing, but nobody who's making the battery just yet. But I think it'll happen probably.
Okay, we'll take your words for that. From Catherine, Shell, how do you see the regulation required by IRA, minimum percentage of local supply, will end up with higher dollar of EV and thus make it harder for the EV adoption in the US, which I think we briefly touched upon.
Yeah. Basically, the question is, will the cost of the supply requirements exceed the value of the credit?
Correct. The car actually more expensive, so people are less likely to maybe purchase them in the near term.
I guess my view is I don't think there's a world in which it makes the car more expensive, because if the value of the credit is smaller than the cost of the new supply, then manufacturers won't do it. You could still sell EVs in the US. You don't have to qualify for the credit. You just don't get the credit if you do that. So at worst, to me, it's ineffective. I don't think it crosses over into being counterproductive, but I don't know whether it is ineffective. Again, I'm not the expert on exactly how difficult it is going to be for each of these sourcing requirements. And similarly to the hydrogen story, there's still lots of guidance to come out. So I think we'll see whether it leans harder or easier depending on where the guidance lands. So I don't know. But to me, it's neutral to positive. It's unlikely to be net negative.
This question is why hydrogen car is slow go into the market in EV as energy source and generation. I think he's trying to ask like a hydrogen vehicle hasn't really picked up.
Because we have EVs and they're better. Very bullish on hydrogen, but not for passenger vehicles. I think in my mind, that battle has been won by electric vehicles for light duty passenger vehicles. And there's really, to me, no place in the market for light duty passenger hydrogen powered vehicles. Now, for really heavy duty, for like Class 8 trucks and stuff like that, I think there's still some reasonable debate to be had, and certainly for other heavy duty transportation applications. But we're just talking about passenger vehicles. You just don't see any momentum for hydrogen at this point for many reasons, much more challenging of a market. I think the distributed scale nature of it and the infrastructure you have to build for hydrogen doesn't make as much sense. We have existing infrastructure and electricity there. We're not facing a huge range problem in EVs anymore. So the main reason to go with hydrogen to me is rooted there. So I'm bullish on hydrogen for industrial applications and really heavy duty transportation, and very bearish for light duty.
Okay, we'll take one last question. Are there any specific areas in clean tech, energy materials refining that you believe the IRA does not address? And how do you think private markets, such as VC, could fill that gap?
I'm focused on climate tech, and within climate tech, there are major categories that the IRA doesn't touch. So food, and it is a big one. There's $20 billion for climate smart ag in the bill. There's not specific tax credits associated with that, but I would say areas like food are only distantly addressed within the IRA, whereas areas like energy and transportation are very directly addressed. Buildings and industry also similarly 1 degree removed. In buildings, there is a bunch of funding for electrification and things like that. There's some money in there for industrial projects and decarbonization, and there's indirect value in the form of cheap hydrogen, for example, but it doesn't get the same degree of direct credit that energy and transportation and carbon management do. There's lots of folks out there looking to finance climate solutions. There were before the IRA, there will be after. I think, again, the IRA is an accelerant. It's not going to make markets, it's going to accelerate them.
And I think the whole private sector, like corporates, banks, they will probably play a big role as well. Great. I see we're at time. Thank you, Shell, for providing such rich insights in this session. I wish we can go longer, but I guess I'll just wait for your next podcast. And thank you for everyone who joined this session. I hope you can stay because next up we have a talk from the Executive Director of Volta Foundation, Yan Ye, who's going to talk about the overview of the battery landscape. So see you at the next session.
Thank you so much.